Aside from choosing the property itself, the mortgage is the biggest decision that you'll need to make when you're buying real estate. And deciding between different kinds of mortgages, fixed and variable, can have a big impact on your costs and your flexibility for years to come. David Pipe here, and today I want to talk about the differences between fixed and variable mortgages in Ontario and some of the advantages and disadvantages of each. So first of all, let's talk about fixed. A fixed rate mortgage is just a loan where the rate remains the same for the entire term. So that means that the payments, the interest rate, and the length of the loan don't change, and the term of this can be somewhere between 1 to 5 years, but can also go up to 10. The advantage of a fixed rate mortgage is that it allows you to plan and budget your cash flow exactly the way you expect. You know what you'll be paying each month for the next, say, 5 years and can plan accordingly. Furthermore, if rates go up during your term, you won't be affected and won't have to increase your payment. The main disadvantage of a fixed rate mortgage is that you might end up paying more than necessary if interest rates fall during your term. This means that you could be making higher payments when alternatively you could have been getting a slightly better deal as rates have fallen since then. Also, you might have to pay a fee or a penalty if you want to break the loan or sell the property before your term is up. Now, when it comes to variable rate mortgages, there are actually two kinds. One is a variable rate mortgage and the other is an adjustable rate. The big difference between the two of those is that in an adjustable rate mortgage, your payments actually move up and down when the rates change. But in a variable rate mortgage, the payments stay the same, but the amortization or the length of the loan will change. That means that more of your payment will go to interest when rates go up, and what's left over will go to pay off your mortgage. So sticking on the variable side, when that happens, you find that your mortgage payment will stay the same, but you might find that your amortization goes into 25, 30, 40 years or so. You might even get a letter from the bank that says that your payments aren't even covering the amount of interest like it's been happening in these years, and you have to actually raise your payment. So the advantage here, if rates fall during that mortgage term, you can benefit from getting that lower rate. Now, the downside of this is that, of course, you may not have total sense of how long your loan might be, and more of your payment will be going to interest in a rising rate environment. In an adjustable rate mortgage, the opposite happens, where your payments actually change, and that can make your monthly budgeting difficult. Although the good news is that you'll have the same amount of loan balance at the end as you'd always planned, you have to be sort of ready for rising and falling payments along the way. So between those different kinds, there's no such thing as the perfect answer, but it's best for you to plan and ask questions so that you can make an informed decision based on your timeline, when you want to sell, for example, or based on your budget, whether it's more flexible or whether you're looking for more predictability. So do you have questions about mortgage rates, what you should do, or buying real estate? You can arrange a free consultation call by just going to wealthtrek.ca and hit the Book Now link, and we'll get started today.